Second quarter of 2012 was a tough one for risk assets in general. I think we were fairly encouraged by some of the performance in various sectors of the fixed income markets. We think about high yield corporate bonds, which tend to be a lot more correlated with stocks. As stocks rolled over in the second quarter of 2012, we did see some of that weakness spill over into high yield bonds, so spreads widen in high yield securities. One of the interesting things, if you look at where spreads started the quarter, they were still relatively high. So even though spreads widened and high yield weakened over the course of the second quarter, because you were generating a lot of income, the total return of the sector was actually positive. So you can have a spread widening yet still have positive expected returns because a lot of negativity is already baked into the cake in many of the sectors in fixed income, and high yield is certainly one of them. So weaker but still positive returns in high yield overall. Another example is in the non-agency RMBS market, residential mortgage-backed security market. This is a sector of the market which got extremely battered, did much worse than stocks through the course of 2011. And even here, it tends to be a higher beta sector. There are pockets of the market which, again, extremely stable, in fact, slightly positive returns for Q2. A lot of that is security selection, being able to avoid parts of the non-agency market which did actually fall 5 to 10%. Our exposure within the non-agency RMBS market was actually fairly stable despite a fairly negative risk market overall in Q2.